power dynamic in the New Zealand property market has officially shifted. The question is, are you prepared for a market where the buyer is finally the boss? Hi, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. This week, we're looking at a market that's undergoing a bit of a recalibration. We've got new data showing national rents falling nearly $30 below their peak, and a rebound in housing consents that's clashing head-on with rising building costs. But it's not just local pressure. Today, we're unpacking how global conflict is cooling off our mini recovery, why the Reserve Bank's sounding the alarm on AI-driven job losses, and a startling new survey that shows FOMO has been completely replaced by a fear of overpaying. Startling? No, I think that's great news. Whether you're a first-time buyer looking for your window or an investor deciding whether to hold or fold, today's data is your roadmap. So let's get to work. Topic number one for this week in review from realestate.co.nz on the 7th of May. Apologies for the delay in getting this week in review out. April rental report, average weekly rent falls year on year in most across the motu. The national average rent fell to $631 a week in April 2026, marking a 1.4% decrease year on year and sitting nearly $30 a week below the record peak set in May 2024. Average rents in Wellington dropped to $620 a week as the capital continues its downward trend, having not exceeded $700 since early 2025, due in large part to regional job losses. Bucking the national trend, Nelson and Bays hit a record high of $617 a week, while Waikato reached a record $583 a week. Nationally, new rental listings surged by 5.1%, with the Bay of Plenty, Taranaki, and Marlborough all seeing year-on-year listing increases of over 30%. Total national rental stock levels remained relatively stable, falling only slightly by 0.9% to 7,955 properties. Central Otago Lakes District remains the most expensive place to rent in the country, with an average rent of $860 a week. The headlines might say rents are falling, but you've got to look at the regional nuances. In Wellington, we're seeing the direct impact of economic contraction and job losses hitting the rental market first. But then you look at Nelson and Waikato hitting record highs, and it's a reminder that demand for quality housing hasn't vanished, it's just shifting. If you're a landlord in a cooling region, you can't afford to be complacent. Well-presented properties are still moving, but you've got to be more considered about your entry points. This is a time to focus on the basics: maintenance, presentation, and tenant retention. Don't chase a peak that's already passed. Focus on stable, long-term yield in areas where the local economy is actually growing. And if you're a buyer in the current market, the fact that rents are lower isn't any concern to you whatsoever, because prices have dropped as well. So the rental returns we're seeing at the moment are actually the highest that we've seen in a long time. Next up, let's have a look at how the building sector is responding to some of these market shifts, with a surprising rise in housing consents. From an NZ advisor on the 4th of May, New Zealand housing consents rise 11% as the sector rebounds. New Zealand saw 37,700 new homes consented in the year ended March 2026. This is the first annual increase following 3 consecutive years of decline. Multi-unit developments, such as townhouses and flats, climbed 13% to over 20,000 consents, while standalone houses rose 9.2%. Regionally, Auckland recorded a 14% increase in approvals, while Canterbury surged 21%, the highest per capita issuance in the country. Despite the annual growth, March 26 saw a slight monthly dip of 1.3%, showing the usual month-to-month swings in construction activity. Economists warn that the sector faces mounting headwinds from sharp rises in fuel and material costs alongside persistent inflation. There's concern that developers may become more cautious about starting new projects later this year if cost escalations continue to squeeze margins. because as we all know, building consents don't necessarily turn into actual new properties. So when we see a 21% surge in Canterbury consents, that sounds really impressive, but we've got to look at the cloud behind that silver lining. While it's great to see the pipeline expanding, developers are becoming incredibly cautious and with good cause. With fuel and material costs climbing, the feasibility of some of these projects is being squeezed from both ends. If you're looking at buying off the plan or starting a build, you've got to account for cost escalation. A consent is just a piece of paper, doesn't guarantee the house gets finished if the builder's margins disappear or if the builder goes into liquidation. In this environment, you need to be really careful about who you choose to do your build and ensure that your finances have got enough buffer to handle these inflationary pressures. Third topic for this week in review, from One Roof on the 4th of May, mini upturn in New Zealand house prices under threat. The nationwide median property value rose a modest 0.1% in April, continuing a small shift in direction with a 0.6% rise over the last 3 months. Auckland and Wellington values dropped by 0.1% in April, while Christchurch and Dunedin values continued to climb. Experts warn the conflict in Iran, a weak economy, and higher mortgage rates, even though they're still below average, in fact cheap in comparison to everything except for the low interest rates we saw during the global pandemic, may actually cause property values to flatten or decline in the coming months. While filled jobs rose in March, which is great news, firms' hiring intentions are expected to pause as they assess the fallout from global conflicts. There's been a significant shift in borrower behaviour towards longer-term fixed loans, particularly the 2-year rate, as people look for a bit of insurance against further interest rate increases. My thoughts on this mini upturn that we've been tracking now looks like it's having a bit of a pause. While we've seen 3 months of modest gains, that 0.1% rise in April isn't exactly a sign of a roaring recovery, more like the market's holding its breath. But what's really telling is the regional split. Auckland and Wellington are still flat, while Christchurch and Dunedin are still showing stronger signs of a recovery. It's a clear reminder that property is a game of local markets, not a nationwide one. The shift towards longer-term fixed rates as insurance is also a fascinating behavioural change in a country where the majority of mortgage owners have previously shown a 12-month fixed rate preference. People are moving away from the shorter-term rates because the global outlook, especially with the conflict in Iran, makes the future feel pretty unpredictable. Borrowers are effectively choosing to lock in certainty for their interest rates rather than running the risk that they might come off a short-term rate when interest rates are higher than average. If you're feeling some anxiety about your interest rates on your mortgages, my advice is talk to your mortgage advisor for help with making a decision about your interest rates. You might even be better off to break a current fixed rate to refix for a longer period sooner rather than later, while interest rates are still below average. If you can afford to, use the cheap interest rates available at the moment to pay down the mortgage, especially on your home, as quickly as you can, so that that'll give you some further protection against future interest rate rises. Also, again, talk to your mortgage advisor. Every extra dollar you pay off now is also going to give you a stronger equity base to help you to leverage into your next opportunity. Don't wait for the market to move for you. Be proactive while the rest of the country's waiting to see what happens next. If you're getting value out of this podcast, please open up your Apple Podcasts or Spotify app right now and hit that follow button. It's the number one way to help us help more first-time buyers and property investors gain access to quality content. And if you want to learn more about how to navigate the property market, join me at one of our free online events called How to Succeed with Property Investing. As a financial advisor and experienced investor, I'll help you to navigate the current market with confidence and make smarter decisions. We're live, online, and independent. We don't sell property. Go to propertyapprentice.co.nz to register for the next free event. Fourth topic for this week in review, from Good Returns on the 6th of May, non-bank lending balloons. Banks offered upfront cashbacks of up to 1.5% late last year to attract customers, resulting in nearly 3 times the usual amount of mortgage debt switching banks in December. Inflation for residential dwellings, contents, and motor vehicle insurance has dropped significantly from 20% in 2024 to nearly zero currently, which is great news for anyone with insurance. The RBNZ expects the war in Iran to lead to a slower economic recovery, increased debt servicing stress, and fewer job opportunities. Potential job losses from AI developments could lead to more borrowers struggling to meet their mortgage payments in the future. National house prices remain below their 2021 peak and have been broadly flat for 3 years, with high inventory in Auckland and Wellington weighing down on the prices. New capital settings may encourage mid-sized banks to compete more actively for low loan-to-value ratio or low LVR lending in the near term. My thoughts on this are the fact that banks spent $100 million on cashbacks just to attract you to use them as the mortgage provider instead of your current bank tells you how hungry they are for safe lending. If you haven't reviewed your mortgage in the last 6 months, you could be leaving some money on the table. The Reserve Bank also warned that job security could be the next major hurdle. If AI takes people's jobs, my thoughts are that for most industries, AI is actually just going to massively improve efficiency rather than take jobs. But if you're worried about your job security, maybe spend some time learning how to use AI effectively. I suspect the first employees to lose their jobs because of AI will be the ones that don't know how to use it to make their jobs more efficient. We're also seeing some relief in insurance inflation, which, as I mentioned, that has been a huge pain point for homeowners and investors. So having some relief on inflation in the insurance area is exciting news. Finally, with topic number 5 for this week in review from the New Zealand Advisor on the 6th of May, first home buyers take the lead in a softer New Zealand property market. Survey data shows the housing market is now solidly tilted in favour of buyers, with a net 45% of agents reporting that vendors are the more motivated party in negotiations. Anxiety over mortgage rates has skyrocketed, with the percentage of agents seeing rate-anxious buyers jumping from just 2% 5 months ago to 65% today. In my opinion, this is ridiculous because interest rates are still well below the long-term average, and you can lock in interest rates for up to 5 years, which should be more than enough to carry us past any potential increases. Maybe you'll be refixing when interest rates are on the way back down again. So talk to your mortgage advisor. Fear of missing out, or FOMO, has virtually disappeared, replaced by concerns over job security and the risk of prices falling further after a purchase is made. I mean, that as well is a bit of a stupid thing to worry about because you only lose money in property if you sell it for less than you paid for it. And banks aren't going to get in touch and ask you to make a lump sum payment off your mortgage just because values have dropped a little bit. As long as you're still paying your mortgage, they'll be quite happy. Price growth remains nearly flat, with national values rising only 0.1% in April to a median of 809,101, which is still 16.8% below the 2022 peak and about back to where we were 2 months prior to the peak of that boom. First home buyers remain the largest sector of buyers in the current market, accounting for 24.4% of buyers as they take advantage of the lower prices and better credit availability. See, everyone should be looking at what the first home buyers do because they don't worry about the stupid stuff. Property investors are retreating significantly, with 50% of agents seeing fewer investors and 58% of agents stating that there's absolutely nothing that's currently motivating this group to buy. I'm stunned. There's a growing trend of investors offloading stock, with a net 27% of agents reporting more investor-led listings than 3 months ago. I suspect those are investors who bought the wrong sort of property for their financial position. and also potentially some people who are now in a bit of financial difficulty with some of the redundancies that have been, that we've seen in the market over the last few months. My thoughts on all of this is that fear of missing out has been completely replaced by the fear of overpaying. We're solidly in a buyer's market, and while that's clearly making some inexperienced investors retreat or sit on the sidelines, it's giving first-time buyers and more experienced investors or smarter investors a once-in-a-decade window of opportunity. It's incredible to see rate anxiety jump from 2% to 65% in such a short time. And it shows just how much the psychological landscape of the market has changed and how New Zealanders, or maybe humans in general, always seem to be able to find something to worry about. For those of us with a long-term view, we look at the data differently. If 58% of agents are saying nothing is motivating investors, that's usually the exact signal that the most successful investors are looking for. When the crowd retreats because of holding costs and flat capital gains, that's when you can negotiate terms and prices that were next to impossible 5 to 6 years ago. This is the ultimate test of your strategy. Are you buying based on today's headlines, or are you looking at the long-term horizon? Today's prices are cheap compared to where they were at the peak of the boom, and interest rates are below average. So if you're buying in the current market, you're not gambling. You're building a foundation for when the cycle eventually turns, as long as you know what you're doing and as long as you're buying properties that suit your current financial position. Don't let the general market jitters stop you from being the CEO of your own financial future. Now is the time to be a smarter buyer while everyone else is sitting on the sidelines. And that's a wrap on a revealing week for the New Zealand property market. What we're seeing right now isn't a market in retreat, it's a market that's becoming more considered. The era of the strategic, data-led investor is back. I want to hear from you. What's happening in your area? What opportunities are you spotting that everyone else is sitting around and just watching, waiting to see what happens? Let me know what you're seeing, or what your top concerns are that are holding you back from reaching your goals. Drop your thoughts in the comments below. If you're ready to stop guessing and start building a portfolio that can weather global headwinds, come and join me at one of our free classes online, where I'll show you exactly how to find good yield, navigate the sideways market like a professional, and get better results when it comes to investing in property. Go to propertyapprentice.co.nz and I'll see you online shortly. If this update helped you to see the market more clearly, please hit the like button and subscribe so you never miss a week of the real numbers. Stay savvy, stay strategic, and I'll see you in the next episode. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.